To unpack what's happening of late, I'm joined by Victor Seanie. He's a portfolio manager at Benguela Global Fund Managers. Victor, thank you so much for joining us. So Reuters is reported a couple of hours ago that US Treasury bonds and stocks had plunged in value on Trump's tariffs, suggesting unprecedented panic. Just unpack what this means and your reading of it all.
Hi, Nompu. Thank you for having me. Yes, the Treasury bond situation is one of those anomalous situations that usually arises during times of major economic shocks. The last time it happened was in 2016. And we also saw something similar happen during the middle of March of 2020 in the midst of the COVID crash, essentially where bond traders, often hedge funds, felt that some of them had positions that they had to liquidate and didn't have enough liquidity. They had to unwind positions. And as a result, there was a very weak uptake of US bonds in the auction yesterday. So the typical percentage uptake of US bonds in the auction is about 19% on average. But yesterday, the uptake was only 6%. And another factor driving that is that the expected higher inflation that we expect to come because of these tariffs has also led bond investors to demanding higher yields on the bonds in order to offset the inflation that will come. And so that's one of the factors also that drove up the higher bond rates. And that's Trump and his administration, because one of the key aims of their tariffs was for government bond yields to decrease in order to decrease the interest that the U.S. government pays on its bonds. Currently, the U.S. pays about $1 trillion in interest on its bonds every year. So at least in the short term, that strategy is backfiring against Trump.
You talk about anomalies. What about the conversation that's been sparked off by some around the possibility of the US Fed intervening to cut interest rates when everybody is foreseeing higher inflation? That is an anomaly, isn't it? And just explain what that's supposed to do in the short term, given that it goes against a situation of higher inflation. If you anticipate higher inflation, you're going to raise rates, you're not going to cut them.
Yes, I think a lot of people in the market are expecting that for right now for two reasons. One, because Trump is directly and very about Mr. Powell cutting interest rates. He's tweeted about it. However, Powell remains staunchly independent and refuses to bow to Trump's demands. And the second reason investors would want interest rates to decline is for some optimism to come into the market and to see in order for equity prices to increase. But given the inflation outlook is very negative for the U.S. because of tariffs, it's quite unlikely that the Reserve Bank of the U.S. will cut interest rates.
Yeah. So additionally, the oil price has lost quite a lot of ground, which might be good in terms of tempering inflation, but it's also a negative sign, isn't it?
Yes, it is a negative sign. Unfortunately, OPEC's timing to increase its oil output is pretty poor. They decided last week, Thursday, that they're going to increase their output by 3 times the amount that the market actually expected. And that was at the time they felt that the fundamentals were positive as well as the market outlook. However, what's happened in the last week has turned that on its head. Now, the outlook for the global economy is a lot less positive than it was a week ago. And so you have more supply and much less demand, leading to a weaker oil price. And is indicative of a weak economy that we're expecting because of the tariffs.
Yeah. So with equities, experiencing major sell-offs, I saw an interesting article that you wrote about opportunities at a time like this. From where you're standing, where do you see opportunities in terms of investing in lower valued quality stocks for the long haul?
Yes, during times like these when markets crash, and when I say crash, we have had a crash because we are in a bear market. The biggest stock market index, the S&P, entered into a bear market territory this week. The last bear market for the S&P was in 2022 during the Russian invasion, and before that during the COVID crash of 2020. Those dates always mark the point where stock prices are lowest, and as you know, the lower the price you pay, the higher the return you generate. Now, you have to be very discerning. The key is to buy good quality companies that have good long-term prospects, but are trading at depressed prices. So you might separate companies that will be negatively impacted by tariffs, such as Nike, who imports a lot of their products from Vietnam and China, as well as a company like Steve Madden, who's still very dependent on China for its shoe manufacturing. And you might go towards services businesses where tariffs aren't as applicable. Examples of high quality service businesses include the likes of Google, owned by Alphabet. Another one would be Microsoft, some service businesses, as well as software businesses which aren't as impacted by tariffs. And on the local front, there's a company like AVI that sells most of its products in South Africa, that being Baker's Biscuits, as well as Five Roses Tea. Those are interesting opportunities. And lastly, a global company like Pepsi, where most of their products are manufactured in the countries where they sell their products by their bottlers, as well as this. Frito-Lay, for example, is in Isando here that serves the South African market. So, yeah, there's a lot of great opportunities on the market at the moment.
All right. Well, thank you very much for those tips. That was Victor Seanie. He's a portfolio manager at Benguela Global Fund Managers. Juliet, I hand it over to you.